Good afternoon, everybody, and welcome to the latest event in Professional Advisor's series of Working Lunches. I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you can keep them that way. It will ensure there's no background noise, so I and our guest from Baillie Gifford can be heard more clearly throughout this webinar. I should also let you know this session is being recorded, and we will send you a link of the recording by tomorrow. So, of course, do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link of the recording of the session, which will arrive in your inboxes tomorrow. Right, today's session is called Cycles versus Disruption, a Case for Growth. We're in an era of unprecedented disruption where long-term structural changes far outweigh the historical growth value paradigm, or at least so says our guest from Baillie Gifford today. The implications of the once-in-a-generation replacement of the infrastructures underpinning our economy are nowhere near played out. So with that backdrop in mind, I'm delighted to be joined today by Baillie Gifford's Ben James, who is a director and US equity investment specialist at Baillie Gifford, our partner for today's working lunch. Over the next hour, Ben will be discussing how Baillie Gifford seeks this disruptive growth and about having the patience required to align their portfolios with the management teams leading these businesses for the coming decades. As ever, do feel free to put any and all of your questions to Ben using the chat function, which you'll find at the bottom of your screen as per a usual Zoom call. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, and that way only I can see it. Just before I hand over to Ben, let me quickly run through our learning objectives, which are to explain the importance, as it says on the screen, explain the importance of company fundamental progress in share price returns over the long term, describe the asymmetry inherent in equity market returns and why it's rational to seek to invest and hold the future outliers in order to maximize chances of outperforming over the long term, and explain why long-term structural changes in society are more powerful drivers of change and disruption than macroeconomic or geopolitical issues. That's the CPD covered. Let's hear from Baillie Gifford's US equity investment specialist, Ben James. Good afternoon, Ben.
Good afternoon, everybody. Thank you for joining us.
Thank you for joining us, Ben. So the equity market at the moment is experiencing some serious headwinds, as I'm sure everyone's aware on this call. How are the team at Baillie Gifford American thinking about things now and going forward?
Yep, thank you, Tom. It's good to join you today. Yes, we are certainly living through some very uncertain and challenging times. I aim to give you some context today in the way that we think about things and why we remain excited for the long-term growth opportunity for a handful of exceptional US growth companies. So I'm going to cover three areas today, Tom. The first two sections should answer that first question and explore our approach within this current challenging environment. And I've called these sections, first two sections, Calm Amid the Storm and Fundamental Resilience. And then the third and longer section, I'm going to explore the long view and the importance of innovation and disruption. In other words, long-term structural changes in society, and why we believe that they are more important in the long run than trying to work out and time where we are in the cycle. So right at the start, I think it's really important to remind all of you attending today of our core investment beliefs in the US equity growth team at Baillie Gifford that runs the American fund. So understanding all this puts everything I cover today into context. So at the core of our approach are asymmetry and longevity. We seek outliers. So we aim to find a few exceptional growth companies in the US when they're underappreciated by the market. We invest in them at scale in a concentrated portfolio, and we hang on to them for a very long time. And we do this because over any 5-year period, most companies don't matter to returns. And if you look at the returns of the S&P 500 over the last 35 years, it shows that roughly 40% of companies go down a bit in any 5-year period, 40% of companies go up a bit in any 5-year period, and the two groups sort of net each other off just above a return of zero. It's only the top 20% of returners, the top 20% of companies that have historically been responsible for the majority of the market return. And they return at least 2.5 times or much higher over any 5 years. And I show you this on this first page here on this graph on the right. You can see the graph on the right-hand side of the page, and I've colored the top 20% cohort in blue. You can see that the distribution of returns over the market over any 5-year period is positively skewed to this long tail of outliers. The key point about this is that it is therefore very rational to focus all your energy on trying to identify the future outliers in this cohort and hold on to them for a long period of time, including through periods of volatility and weakness, if the opportunity is still there for these companies, and that's key. The other key point is that you only need to find a few of these companies to win in order to make a lot of money for clients in the fund. It's not about trying to get 51% of your stock picks right, but instead it's about harnessing this asymmetry. It's not how often you're right, but how much you make when you are right that matters, letting your winners run. And that's the really compelling aspect of proper long-term equity investing. The most you can lose in any company is theoretically 100%, so long as you don't keep adding to it. But the most you can make in one, if you're right, is unbounded. A company that returns 5 times its original investment, 10 times, or even 20 times or more, will more than offset any mistakes you make. So it sounds simple, but it's very hard to do, particularly when there is a lot of uncertainty and fear in the market, and sentiment feels overwhelmingly negative, and you're constantly being asked, why aren't you changing it for the current environment? But it's precisely at such times where acting for the long term is the most important, Tom.
Just jumping in there briefly, Ben. Given the headlines we're seeing, a lot of macro geopolitical issues, why would people want to hire a growth manager in this current environment, particularly in America, where it's famously hard to beat passive markets and passive investors?
Yeah, good question. Why would you invest in growth companies right now in the current environment, and why the US? Well, we've got our first poll question today, which I think should help answer that question. It is, what is the most important determinant of share price outperformance rather, over any rolling 5-year period? Is it market direction, bull or bear? Is it rate of earnings growth? Is it geopolitical shocks, or the level of inflation? If you wouldn't all mind having a guess, an estimated guess at that, would be great. Why the US? It is a notoriously a challenging market to invest in, but the reason why we're so excited about it and why we think we can add value is because of the inefficiency within the market that I'm going to go through. It's the most innovative portfolio, innovative country in the world, produces more growth companies than any other, and outliers are particularly dominant in this market, as I'll come to explain. So that's right. The result of the poll is has come through is correct. The rate of earnings growth is actually the dominant driver. Fundamental progress at companies is the strongest driver of share price return and outperformance over any 5-year period, Tom, and beyond. Over shorter time frames, other factors start to have stronger influence over share price action. Geopolitics, the macro environment, inflation, shocks, sentiment, and so on. But when you stretch the time horizon out, it's all about fundamental growth. And we've dug into the detail of the blue cohort that, remember, I showed you. They are overwhelmingly growth companies. And here's why we remain calm amid the storm. It doesn't matter what your starting point is. Over the last 30 years, the relationship remains true, whether growth or value are in favor, whether there are wars, high inflation, interest rates, and even bubbles. And I'll show you that here. So on this slide, I show the rolling 5-year returns of the top and the bottom quintile of companies in the S&P 500 in terms of earnings growth over a 5-year period. So this gray line here at the top is the top quintile of fundamental growers, and the blue line at the bottom is the bottom quintile. And here is the median 5-year relative returns. So this is showing the median 5-year return, for example, from January 1996 through to December 2001. The median return would have shown you here that the top performing earnings growers outperformed by 15%. So what's clear here is whatever your starting period, whether it's the peak of the tech bubble here, or at the start of just before the great financial crisis here, whether value stocks were outperforming growth stocks, which is the gray period. So value stocks outperformed in these gray periods here in aggregate. If you pick the top growing companies in terms of earnings growth over the next 5 years, you would outperform. So this is market inefficiency on a chart. It's clear that there's a direct relationship here between fundamentals and share price returns, but it's extremely hard to capture it because it takes a focus on 5 to 10 years of change. It means you have to think probabilistically about what a company might look like in 5 years' time. You have to be comfortable with uncertainty and be prepared to ride out volatility as the market buffets you in the shorter term with sentiment and other things like politics and macro. But it's precisely the thing that you should be focusing on today, identifying the stocks today that have the best chance of delivering the top quintile revenue and earnings growth in the next 5 years to 2027, and holding on to them while the rest of the market frets over the headline grabbing short-term voting in the market. So this is something we've been doing and riding out over the last 2 years in particular. Our fund's volatility since early 2020 is unprecedented in its 25-year history, and we did not consider outperformance of 110% in 2020 possible, nor did we envisage underperformance by 30% in 2021 with continued painful weakness this year to date. Steep share price falls at the moment have occurred because of the challenging backdrop of ongoing supply chain disruption and the highest level of inflation that we've seen in the US for 30 years. And we're absolutely horrified by what's going on in Ukraine. And we understand how challenging that can be, and that is for investors in the funds. But related to what I've just been saying, I'd like to quickly focus on the fundamentals of the companies that we invest in, which leads me to question 2 on our polls. Question 2 is the last 2 years in the fund has seen the most significant volatility in our 25-year history. Which year, though, do you think saw the strongest revenue growth in the fund? 2019, at the bottom there, the year up to before the pandemic, 2020, which saw significant outperformance in the fund, or 2021, which saw weakness in the fund? And whilst we're waiting for that, yes, please do ask questions via the chat. Now, given what's happened with the fund, it may surprise you with the answer. The answer is 2021 by a significant way, actually. It was surprising because this was when economies were opening up again after the lockdowns of 2020, and the fund delivered higher growth on average in 2021 than in 2020. 40% of our portfolio delivered above 50% year-over-year sales growth, compared to 31% in 2020. And the stark difference between 2020 and 2021 is largely driven by market sentiment. So re-rating in 2020 and de-rating in 2021. And I'll show that on this next screen. So yes, it's been a challenging, uncomfortable 12 months, but you can see the progress of the fundamentals in the portfolio over the 3 years. And the fact that virtually all the portfolio is growing above 25% per annum. Now, If we focus on the ongoing fundamentals, the portfolio is in ruder health than we think the market is ascribing it today. So 80% of the portfolio is profitable, has positive free cash flow. It has a net cash balance versus a highly indebted market in this inflationary and rising interest environment. And it's investing heavily for future growth. So there's a lot of discretionary unprofitability in there and a lot of flex. And I think critically, what I'm going to focus on now for the bulk of the presentation is the fact that the long-term structural drivers of change, these factors that are more important than the cycle, these factors that drive revenue and earnings growth over a 5 to 10 year period for innovative companies, they are more intact than ever before, and in fact spreading faster across the economy than we've seen in the past.
Just jumping in again there, Ben. Just picking up on something you said about earnings and how it relates to the portfolio and the companies you hold. With growth stocks generally, I think recently, is there kind of been a higher disconnect between earnings and revenue and their prices and how they're valued in the market? With stocks like Tesla, is there kind of a bigger disconnect than before where we are?
I think it's absolutely right to say that the last 2 years has magnified the disconnect in both directions, I would say. It's absolutely clear now, looking back, that towards the end of 2020, the market got extremely hot, and you can see that through the growth of SPACs and there's some frenzies in the market. On the counter to that, we think that some of the selling, particularly of the faster growing stocks, has been overdone. This is the challenge in the short run, that sentiment and fears over rising interest rates this year and rising inflation have massively punished growth companies whose earnings are far into the future. But the key thing for us is that our structure allows us to try and look through that noise and focus on what we think will be the important drivers for earnings over a 5 to 10 year period, because as we've seen, that's the most important factor that drives share prices. And so we have to endure that volatility when the fundamentals are still intact and the opportunity is still there, in order to capture these outliers over a 5 to 10 year basis. So I would say it's been amplified, Tom, and that's hard to deal with, but something that we have to really focus on and looking through so that we capture the right companies for the next decade.
So ignoring that kind of cyclical nature of the market and the effects it has in the short term, why do you think disruption and innovation are more important than those factors?
Yeah, so this is my contention and the team's contention. Disruption, long-term structural change, is more important for long-term returns than trying to time the cycle. Now, this is how we invest. Others, build their portfolio trying on a shorter-term basis, and that's absolutely fine. Other people can use us in an asset allocation way. That's absolutely right. But this is what we're hired to do: is to focus on these huge structural changes and investing in companies that will exploit them in order to play that role within your portfolio. So I'm going to start this part of the presentation, the long view, with sort of 3 core premises that I'll work from. The first is that investment opportunities aren't living in a vacuum, right? They're conditioned by the world we live in. So your investment strategy, which I hope I'm bringing to life here, should be informed by the real world. So there's a lot to unpack in that phrase, the world we live in, especially right now with all the challenges of inflation, interest rates, supply chain disruption, the war in Europe, and shutting down in Beijing and China and so on because of COVID. But what I want to focus on is these structural forces, because I think they are more powerful over 10 years. And they'll provide more opportunities for investment than trying to time the market. And it's specifically for growth investors, funnily enough, which brings me to my core premise number 2, that disruption breeds growth opportunities. Disruption triggers like dislocations between supply and demand. These voids, these gaps, present opportunities for an entrepreneur to fill with new solutions. And the third core premise is that we're living in an era of unprecedented disruption. And I'll back that up with some evidence and then some lessons from history. So the evidence is on this next slide. I'm sharing now. So in The Intelligent Investor by Benjamin Graham, the father of value investing, he defined a growth stock as one that would double earnings per share over a 10-year period. That's the world that he lived in. That was growth to him. And it was roughly 7 to 8% per annum compound annual growth rate. Now, that was back in the late 30s, 1930s. So today, the median 5-year CAGR for the top 10 holdings in our portfolio by sales growth is 48%. That's the median. And this isn't just COVID effect. In the 5 years preceding the pandemic, the top 20 holdings in the portfolio grew at an average of 50% per year. So fundamentals aren't just strong, they're exceptionally strong. And we're living in a very different world to the one that informed Ben Graham's thinking. Now, let's look at the history of technological revolutions to sort of back up my point about us being in the most disruptive era of human history. And I'll ask our final question for the day, and it will become relevant in a minute. My question is, what proportion of the market, so the S&P 500, do the 10 largest companies in the US represent today? Do they represent 20% of the benchmark, 25%, or 30%? If you could put your answers in, that'd be great. So this is the top 10 largest companies in the US in the S&P 500. What percentage do they make up? So the answer is 30%, and most of you got that right. It's actually 31%, but just seemed easier to do it in 5% integers. 25 years ago, in 1997, when we launched the American Fund, the top 10 companies represented 19%, in fact, it's about 18.5%. And today, the top 10 is 31%. So nearly a third of the world's largest, most innovative, deepest market is dominated by 10 big companies. And looking at the concentration even more, the top 5 is even more stark. So in 1997, the top 5 holdings in the S&P 500 were General Electric, Microsoft, Exxon, Coca-Cola, and Intel. And they made up 11% of the market. At the end of March, Apple, Microsoft, just gone, Apple, Microsoft, Amazon, Tesla, and Google make up nearly 24 and a bit % of the market. So 5 companies dominate a quarter of the world's largest and most innovative market. Now, despite this doubling in concentration of the top companies, we believe that actually we're about to tip into a new era. We're at the tip of the iceberg of what change is to come. So as optimistic long-term growth investors, we think that innovation is speeding up and spreading out, and we're closer to the beginning of this period than we are to the end. We believe we're entering what we're going to call a golden era of the information revolution, with opportunities for investing in exceptional US outlier growth companies, broader and more exciting than actually ever before. And from history, Carlota Perez has done some work on this. She's a British Venezuelan researcher. She specializes in social and economic impacts of technological change. She's done some really interesting work on this, on the work of technological revolutions. And she's identified 5 major waves of innovation over the last 250 years. And they were, 1, the Industrial Revolution, which started in the 1700s with the opening of Arkwright's mill in Cromford. 2 was the age of steam and railways, which was started in the early 1800s. Then 3 was the steel and electricity age in the late 1800s. Then 4 was the age of oil and cars and mass manufacturing in the early 1900s. And the fifth is the one we're in now. It's the information technology revolution. And what's most interesting, I think, about Perez's work is that she realized that all these waves of innovation followed a similar pattern. They all took a really long time to play out. That's really key. 50 years or even more in some cases. And each was split into two distinct phases, and I'll show you them now. So in the first half of each revolution, the new technologies associated with each of the waves were confined to a relatively small part of the economy, and they were adopted by only a few sectors. And this creates lots of turbulence, lots of change, because you had lots of capital chasing a small number of opportunities. And because technologies were narrowly deployed, you witnessed increasing income inequality and social unrest. But in the second part, the deployment phase, the new technologies started to spread out to the wider economy and resulted in a golden era of employment, economic growth, and opportunities. And it wasn't a new technology anymore. Think electricity, steel and manufacturing, trains, they're just normal now, right? So the turbulent phase is the installation phase, and the golden era is the deployment phase, as shown here. And we think we're here. We're in this turning point into the deployment phase and into the golden era for the information age. So the current wave of innovation, this installation phase, has come about on the back of the internet, mobile phones, the AI, and now the emergence of the cloud. And for the last 20, 25 years, these technologies have been limited, as the Perez model would suggest, to a couple of narrow sectors in the economy, mainly retail, advertising, etc. And that's why we've seen the rise of these big e-commerce and big tech platforms, which is why they dominate the US market now. But when we look at the market today, we see the beginning to see these new technologies spreading into previously untouched industries and sectors, in fact, everywhere in the economy. And I think this is what is most underappreciated by so many in the market today. There's still vast swathes of our economy that are relatively untouched by this new infrastructure of the information age. Now, new infrastructures like electricity, railroads, and so on don't come about very often. So what I'm going to focus on is the long-term structural changes. I think this ties into the opportunity we see for the next sort of decade. And the infrastructure changes I'm talking about are two, and they affect pretty much everything in the economy. It's the internet as the infrastructure upon which commerce, media, information flow, and the cloud as infrastructure upon which IT is stored, powered, and distributed. Now, I'm waiting for the questions to come in to say, Ben, the internet, that is well understood, it's hardly novel. I'd say that's pretty fair, but I'll point to two things. Both these things, the internet and the cloud, are still very early in penetrating the markets that they affect. Even in e-commerce, for instance, it's still 15 to 20% of retail in the US. That's it. And secondly, the knock-on effects that come with each of these shifts are profound and almost fully impossible to grasp. So perhaps another way to think about the Carlota Perez technological surge cycle graph is this way. And what I've done is I've added those top 10 companies from the last 25 years and then just now. You can see in 1997, as the internet began to emerge and we launched the American Fund, this is the sort of end of the old economy. The market was dominated by GE, apart from Microsoft, Exxon, Coca-Cola, Merck, Royal Dutch Shell, Altria, Procter & Gamble, and the emergence of the sort of information tech companies, Microsoft, Intel, and IBM. And now look at it. Apart from Berkshire Hathaway, United Health, and Johnson & Johnson, and Tesla, arguably, it's all tech companies. What's really exciting is the internet and the cloud come to dominate every aspect of our lives over the next 20 years, is this bit here. What's that going to look like in 20 years' time? And that's what I think is really exciting and something we're going to explore. So I'll offer a couple of reasons why I think that new infrastructure of the internet and the cloud are so profound and so underappreciated still. And I'll bring them to life with some examples. So a great place to start is, when discussing like infrastructure change outs, is a mental model that we use in the team. It's called pace layering by Stuart Brand, and I'll show you it here. So Stuart Brand, who wrote the book, The Clock of the Long Now, he broke society down into 6 layers. Fashion at the top, then business, infrastructure, governance, culture, and nature. And he makes 2 overarching points. The pace at which each layer changes goes from the fastest at the top and slows down as you get deeper into the stack. So fashion changes rapidly, as I'm sure we can all attest to. Nature, not so much. The second key point is that the power to affect change grows as you get deeper into the model. The lower levels control and constrain the levels that sit above it. That is, what happens in culture affects governance. So think regulation is affected by our culture, and the regulation then informs the infrastructure that sits upon it. And then businesses build their commerce, build their ideas on top of an infrastructure level to satisfy our fashion and so on. The point here is that the internet and the cloud represent a wholesale swap out of this layer here, the infrastructure layer. Now, in this model, we see that infrastructure is sort of halfway through the stack, and that means it doesn't change very often. But when it does, it has massive knock-on effects on the layers above. And the way that I see it is that the companies we invest in live in this layer here, the business layer, and they address markets that are in this business layer. If the infrastructure layer changes beneath it, those addressable markets in the business layer are massively disrupted. And it kicks off a shift in the TAM, a shift in the total addressable market, essentially a completely clean slate for innovators to build upon. And the markets that these infrastructures underpin are massive. So a good example here would be Shopify. So Shopify is an online e-commerce platform that offers merchants all the tools that they need to run their business online. And through its platform, you can access tools to build websites, handle payments, do shipping, you can manage your inventory, and even access capital. And it's all really cheap and on demand and over the internet. So there's no need, for example, for upfront capital costs, data centers, and so on. You can literally now start an online business with a good idea and your smartphone. And you're no longer at a major disadvantage against big companies, multinationals, because Shopify pools all the collective scale of its 2 million merchants and passes the benefits of this scale onto customers. It's scale as a service. And now this has driven an explosion of the new direct-to-consumer companies in that business layer. Some of them are so large now that they themselves have listed on the stock market. Allbirds, the shoemaker, is one recent example. 2 million merchants on the Shopify platform, second only to Amazon in the US in terms of the amount of commerce it does. And quick reminder, that is disruption in e-commerce, perhaps the most established sector so far of the internet age. And what's really exciting is we're seeing that infrastructure change out happening in every sector of the economy. So that's the first reason why I think it's so profound. The next, I think, is even more powerful. And the second reason involves the Pareto principle and power laws. I mean, what am I talking about here? I'll show you on this slide and we'll go through it. The context here is that there are multiple ways in which a system's outcomes can be distributed. And when I say a system, let's say market. So there's multiple ways that a market could end up in terms of its results. And 2 popular ones are shown here. You've got a normally distributed market and a skewed distribution. The former here, the Gaussian distribution, normal distribution, this is a traditional bell curve. There's no extreme events, very predictable pattern of outcomes. So average height in humans. Men tend to cluster around 5'9" here, and there's no 18-foot humans the last time I looked. The Pareto power law, Paretian distributions, on the other hand, they involve power laws. So there's an uneven distribution, winner takes most, and extreme events happen par for the course. And that's like the stock market. We see these distributions all around us, the size of cities, magnitude of earthquakes, concentration of power and size in social networks or search engines, Meta, Facebook, and Google. The key point is that in a system, in a market that abides by power laws, extreme events aren't anomalies. They are the natural order. And as I said, over the last 25 years, we've seen a number of industries shift from looking like this to being normally distributed to this. So advertising is a great example. Global advertising budgets have steadily shifted online, and the large walled gardens of Facebook and Google dominate. So as an investor, as I said at the beginning, who seeks these, the outliers, i.e. extreme events in capital markets, you can see why we are drawn to understanding what changes a market from that on the left to that on the right, and what causes power laws to kick in. So let's have a look at that. So how can we tell whether the market we're looking at, the market we're analyzing, will have outcomes that follow this normal bell curve, or will plant the seeds for extreme outliers? Well, the answer lies in connectivity. And the quote on the right-hand side of this page here, if you can see it, explains it really nicely, I think, captures it well. So once independence among data points collapses and interdependence or interaction occurs, then the seeds of power law formations are planted. So in layperson's terms, the likelihood of skewed distributions rise in interconnected networks. So let's bring the notion of new infrastructure and power laws together. So on the left-hand side of this page, I've clumsily tried to show the process of a system going from unconnected to connected. So on the left, you've got a load of unconnected nodes in a system, and it's normally distributed. Load of, let's say, companies. In the middle, you've got the interim step, where nodes start to get connected by roads or railways or telephone lines. And that eventually leads to something like this on the right. Network effects, which we all heard about, they've led to some nodes here that get really large. These are outliers, they dominate. So the way I like to think about this image is that this large blue circle here on the right is Amazon in 2020. And the picture on the left here is retail 100 years ago, before they all started getting connected, you know, small shop fronts in local villages and so on. So participating in a network that becomes hyper-connected leads you to Amazon. And now you may see where I'm going with this, but the two new infrastructures I've highlighted, the internet and the cloud, are networks. They are hyper-connected networks, globally connected. And this explains the extreme outliers that we call Amazon, Google, Apple, the top 10 holdings. Companies that have enjoyed increasing returns to scale as they grow, as opposed to diminishing ones. Now, the key point here is, the larger point here is that these companies, the FANG stocks that everyone unfortunately calls them, they're often thought of as anomalies. Now, in some way they're outliers, but the result of extraordinary vision, powerful strategies, no doubt, great business models, all coming together. But the key point is that the extreme nature of their success could simply not have happened if it wasn't for the networked nature of the market, the system that they're participating in. It was the network that really enabled any of this. And here's the punchline, and what I've been barking on about. The hyper-connected network now isn't confined to just tech companies, it's everywhere. It sets the table for more outliers to emerge. There are markets now that are normally distributed that are starting to shift to skewed distribution, and outliers are beginning to emerge. And the shift will take years to play out. And we're seeing this in programmatic advertising with Trade Desk, Lemonade in insurance, which is aligning itself with its people it insures, and using behavioral technology to align itself. Coursera in education, and so on. And two I'll focus on here before coming towards the end are Carvana and Snowflake. Two very different companies, but Carvana is a used car company. They sell used cars, which is hardly very exciting, but actually what they're doing is using all the tools that Amazon use so powerfully in book selling and retail to the used car market. So if I may, the used car market is currently like this, very local, very normally distributed, no one large player dominates it. But Carvana is using the internet to provide national scale, the best choice, the best selection, the best price and convenience, because you can buy a car, it gets delivered to your house, you can try it for a week and hand it back if you don't want to keep it. They're providing that through a network which is getting cheaper and faster to run each year, whereas the bricks and mortar companies on the forecourt don't have that advantage. And the beautiful thing about Carvana is that even if people's pockets are less full and we have to tighten our belts, it can still continue to grow even if the market is shrinking. We don't need the economy to be healthy and growing for Carvana to grow, because it is currently a small percentage of an $800 billion market. And we're seeing it go from normally distributed to a few outliers coming through. Therefore, it could grow and grow and grow for a decade plus. And similarly with Snowflake. Now, Snowflake is a cloud computing data warehouse company. It helps companies easily securely unify their data, integrate it, analyze it, and share it on the cloud. Unfortunately, much of data is currently born and remains in silos. And these silos are either on-premise, like on a database in your office, or in the cloud, in software applications from customers. And it's just fragmented across departments, data centers, and so on, and multiple public clouds. What businesses struggle at the moment to do, as we all shift everything to the cloud, is to access it, govern, mobilize, and service data for your business. What Snowflake has is a layer in between business and the cloud, is a global data cloud network where thousands of organizations mobilize their data with basically infinite scale, concurrency, and performance. And it allows you to organize and unite their siloed data, easily discover things, securely share governed data, execute really diverse analytic workloads around the world. And it's constantly being updated and shared across the global network. And it's used, for example, by retailers. They use the data cloud to centralize and share live data with consumer packaged goods companies, supply chains, other partners, allowing them to optimize pricing, accelerate inventory turns, increase profits. Healthcare provides data, uses the cloud to securely share live health data internally and with partners to provide quality patient outcomes, reduce costs, shorten time to market, and so on. And manufacturers do it to synchronize supply chains, increase plant productivity, and so on. And there's oodles of examples. But the key point about these two is that they are one of dozens of examples we're seeing of these networks emerging to provide solutions and grow, even if the economy is challenged, and markets that are shifting from being diverse and not dominated by one player to being dominated by the winner takes most. So I started this final section with the premise that the investment opportunities are conditioned by the world that we live in. And hopefully this gives you a sense of how much disruption we think and how much change is just coming through now, and how much opportunity lies ahead for patient growth investors that can identify the future potential winners and hold on to them through volatility. Now, shifting gears slightly at the end, I wanted to talk about why the growth versus value debate and what we're talking about now in the financial press and so on is a red herring. It's all about identifying outliers. outliers are what really matter in the long run. And some of you have maybe heard us talk about this before, but I presented it on this page. This is the graphical representation of a piece of research by Professor Hendrik Bessenbinder, who asked the question whether stocks outperform treasury bills. And he looked at the last 90 years of the US stock market from 1926 to 2016. And he showed that the market, 25,000 companies, created $35 trillion of wealth above and beyond cash, basically. But it was extremely skewed. It was a Pareto distribution. 24,240 firms returned the same in aggregate as cash over 90 years. 1,000 companies generated all the net wealth. And it was even more condensed than that. 90 companies generated half the wealth. So that's 0.4% of all US stocks that ever existed generated half the wealth. And you don't become one of these outliers by riding the vicissitudes of cycles. All of these companies here were driven by innovative business models addressing large market opportunities, run by exceptional leaders addressing these vast structural changes. So our approach is to try and identify the handful of exceptional growth companies that are addressing these long-term structural changes, possess the sustainable competitive advantages and unique cultures that will serve as a competitive advantage, which is why our portfolio looks like this. Each of the circles represents one of these long-term structural trends. The future of commerce, the brown circle here is the argument, there's Carvana, that commerce will continue to shift online, whatever the weather, and that a few of these dominant players will emerge. The new enterprise is the fact that all on-premise enterprise software essentially is moving into the cloud, and a few of these exceptional new businesses are emerging like Snowflake, Cloudflare, and Datadog. And in healthcare, for example, it's only getting cheaper to sequence a genome. We're only getting more and more accurate, which means an era of personalized medicine and cures rather than treatment is basically upon us in the most inefficient, costly market in the US, healthcare. So each of these long-term structural disruptive trends should drive long-term opportunities for innovative companies to grow their revenues for a long time and grow their earnings for a long time faster than most, which should improve their chances of being in the top quintile, which should improve their chances of outperforming for the long run. So that's what we're focusing on, and happy to take any questions.
Thanks for that presentation, Ben. As Ben just said, it's time for the Q&A session now. We've got about 10 minutes or so to do so, and I've already got some questions in. But before we move on to that, can I just remind people that if you've only got your first name in your Zoom name, if you could add your surname to it, because then otherwise we don't know who you are and we can't send you CPD. So please just put your full name into the Zoom, into your Zoom profile. Otherwise we can't send you your CPD, sadly. But anyway, Ben, back on to you in the presentation. Someone's asked a question just kind of referencing the last part of your presentation, which says, do you have any concerns that your hyper-connectivity thesis might be threatened by a possible forward trend of deglobalization?
That's a really good question. I think deglobalization and reindustrialization of America is something we've been I know we've been talking about it, and it's something that has made us look for alternative ideas than perhaps your Amazons. What's your next Amazon? What's the next global champion? And with the increase of robotics, AI, and improvements in technology and manufacturing, there is an argument that in the future we are less globalized. For example, in the fashion industry, you might not outsource your manufacturing of clothes or whatever to developing countries, because you can grow your cotton or in a vat, and you can use machines to spin it and dye it and put it into the factory which is next door to the vat, and all at scale, and far cheaper. Now, the interesting part of that is that's great for the US, probably. Less good for developing economies, particularly not necessarily China or Vietnam, but those who are wanting to be the next China, next Vietnam, to be the global sort of manufacturing hub. I don't think the hyper-connected, I don't think we're going to be less connected, so which is key. I think you'll see, as is already happening, the splinternet. So you've got three variations of the internet already, we would argue. You've got the US-dominated part of the internet, European regulated internet, and then the Chinese internet. The US internet dominates the world. Then you've got Europe and then China sort of as well. So the splinternet, if you want to call it that, I think still offers up, though, if you think about how many people are connected, markets which are absolutely vast. The key point about it is that even in the US, it's so big, the economy, the US being connected allows Carvana to turn the unconnected local shop front for cars, your local forecourt, into a national digitally run business. The market doesn't need to change. It's just changing the market and sweeping up all the incremental dollars that shift online and provides a better service and so on. And it will grow and others will decline. So that's how we're thinking about it. I hope that's helpful.
And coming back to, you referenced at the beginning, we spoke a little bit about growth stocks and how they performed recently and perhaps not so well. And I looked at the Baillie Gifford American Fund for webinar. I think it's down 40% year to date or so. Is that because these pandemic stocks like Netflix, Moderna, Peloton haven't, have seen drastically different attitudes or from stock picks anyway towards them over the last 12 months that performed really well in the pandemic and have taken a bit of a dive since?
Yeah, so it's really complex, Tom, and who's to know exactly why a share price moves? The stock market is an extremely complex system, but in sort of general terms, there are sort of three buckets or three explanations behind what's moved. It's no doubt that a few of our holdings have now hit fundamental issues that have surprised us. And the key sort of headline ones in that are Netflix, Peloton as well. For Peloton, you could actually argue that the pandemic was bad for Peloton. And the reason why is because it was growing very nicely before the pandemic, and we could see this long-term growth trajectory as it disrupted fitness and made it digital and connected, and could take a significant portion of the high end of these boutique gyms, and you could comfortably make, in our probability assessment, a lot of money through this. They were an obvious winner of the pandemic, and the management team leaned into this opportunity. And the problem was execution. They messed it up in the short run and went too hard, and should have actually been more cautious. In hindsight, it's very easy to say that, but what we still own the company Peloton. It's a small position, and we've met with the management since the new CEO has come in, and the new CEO, who's the ex-CFO of Spotify and Netflix, is extremely disciplined, and if he gets it right, will become extremely more wealthy than he is already, and the company will do well, and we could still make an awful lot of money, and it's a very exciting area. So you've got this challenge of fundamentals at Peloton still are growing really well. Its digital fitness folks subscriptions are growing at 60% per annum, which is fantastic. And yet they mishandled it on the execution side. Netflix is a more challenging one because we were expecting a pullback in demand because it was an obvious beneficiary of lockdown. That's not why we owned it. We've owned it since 2014. We knew the long-term trajectory for Netflix was a combination of increasing prices in its more mature markets and margin expansion there, coupled with ongoing expansion into international markets, leveraging that international content and amortizing it over years. Now, what's become really clear is that even Netflix, who are the best probably in the industry at data prediction and analyzing data, didn't see this fall coming. And so that is the thing that's giving us most pause for thought. We expected a bit of a headwind and share price weakness because of the concerns over interest rates knocking growth companies. It was the fact that there was a slowdown across the board internationally that Netflix weren't expecting surprises us, and this could tell us that there's the impact of inflation and folks having to tighten their belts across the planet is more impactful. But it's with everything, we take our time on these decisions, because the biggest mistake you can make is selling one of these outliers. If we sell Netflix and in 5 years' time it's gone up 5x and could be the best returner in the S&P 500, we've done our clients a disservice. And so we have to dig into the detail and think probabilistically about where the world might be in 5 years. What about the company might be able to make it successful? Its track record and culture is extremely strong. They've pivoted their business on 2 separate occasions successfully and has an incredibly effective culture. So we don't want to rush to a decision. On some of the other ones you mentioned, Tom, Moderna has sold off because there's a lot of focus on from the market on the fact that they don't think its revenues from and profits from the COVID drug is sustainable. We take the complete opposite view. We think that COVID is to be here for a long time. Not necessarily all of us having booster jabs, but particularly those in more vulnerable groups will need to have booster jabs globally. And Moderna has developed a sort of pan-respiratory vaccine, which includes the flu and COVID. And so that's more expensive and better value for money, though, because it delivers 3 jabs in one. And we can see it delivering the $20 billion of revenue as an annuity through this annual seasonal respiratory jab plus the CMV jab. But the critical thing is that means that the market is giving nothing to its pipeline of 40 drugs in the pipeline, all of which have been massively de-risked by the success of the COVID vaccine. So for that, the fundamentals are absolutely brilliant. And the market is doing it a disservice in many ways, probabilistically, we think.
We've got about 45, 60 seconds for one last question. It kind of moves on from the question I just asked. It says, even though buy and hold patience is a key driver to returns within the growth funds, what drives allocation changes within the portfolio? So they're turning a smaller position into a larger one and vice versa.
Yep, great question. So it's all about competition for capital. We drive our sell discipline through our buy discipline. What do we want to add to? What do we want to bring into the portfolio? So we focus on the optimism first, what we want to get in or what we want to add to. And then we have to go through the portfolio to understand what we would be willing to sell for that. And a recent example would be we added to Snowflake and HashiCorp, these cloud companies, because their growth is continuing. The shift to the cloud is going to carry on. Companies need to be more agile and resilient in uncertain times, which means you need to have your data in the cloud and you need to access it. And these are the best of breed. So it's almost like they're unaffected by a lot of what's going on. So we added to those at the expense of a company like Wayfair, which is a consumer-facing online home furnishings company. We took a bit of money out of that. We've made quite a lot of money in Wayfair thus far, but we took a bit of money out of that just to represent the fact that it's going to be harder for consumers, or they're going to be less prevalent to spend in the moment because of the rising costs of living. Mm-hmm. So that was one example of what we would readjust in the portfolio.
Brilliant. I think that's all we've got time for. Thank you, Ben, for a fascinating presentation there and for answering the questions in a short, sharp Q&A session at the end.
My pleasure. Thank you, and I look forward to carrying on the discussion.
And as I said, if the question didn't get asked, I know there's a few questions that weren't asked across Ben, send it on to Ben and Baillie Gifford, and I know they'll answer those questions for you after the session is done. Now, before we wrap up, let's just take a quick look at those learning objectives again. I won't read them out, and I'm sure Ben has addressed them because I know he has in the last hour or so. So I'll just thank you again for your questions and thank Ben for joining me. As I said, if they weren't answered, then Baillie Gifford will do so for you over the coming days. But before we sign off, let me just remind you of some dates for your diary. In the coming weeks, we have 4 2-hour regional working lunches, so in person with actual lunch, with Orbis Investments and Next Wealth coming up. So if you're in Edinburgh or Liverpool on the 11th and 12th of May, or Bristol and Brighton on the 25th and 26th respectively, there are places left. So visit the PA website or simply Google Professional Advisor Working Lunches, and you'll find the website easy enough to get more information and sign up. So we've got a few more spots left on those, and they are good. So do come along if you're in those cities. And on the 1st of June, we'll be running the next online professional advisor working lunch with Schroders, who'll be reviewing the key business issues emerging from their H1 advisor survey. Then the following 2 weeks, we're actually back on the road again with our new Smarter Business Roadshow, the first time we've run it, which is designed to help those either running an advisor business or a department within one. The roadshow will visit Harrogate, Warrington, Birmingham, Bristol, and London between the 7th and 16th of June, and we'll be providing you with expert speakers on the key issues within advisor businesses, so things like consumer duty, outsourcing, employee and client engagement, and the new breed of investment platforms, tech, and of course, succession planning. And finally, on the 29th of June, we'll round off the month with yet another online working lunch. We'll be joined that time by Philip Scott from Baillie Gifford, who will give us an update on the Baillie Gifford Managed Fund. If you come to all that, that's a total 6 hours CPD for you. So we've got you covered at Professional Advisor. That's it for today's session. All that remains is for me, once again, thank you all, and thank you, Ben, for his presentation and for answering our questions. I hope you found this quick 1 hour session helpful and worthwhile. And if you did, then we'll look forward to seeing you again. Goodbye.